Okay, so let's have a look at the second adjustment for part A for your ratio questions for the 2021 Fauci PLC. So it says look at the return on capital employed. So the formula that we need to know for return on capital employed looks something like this. So net profit before interest and tax divided by your capital employed multiplied by 100 over 1. So your net profit then, so we need to go back to the question, find out what our net profit is, find out if you paid any tax or interest and add it back on, and divide by your capital employed. So your net profit for the year is 39,000. Net profit before your interest and tax, so we've paid interest here, so you need to take away our interest from it. So your net profit before your interest and tax, so we're going to add the 20,000 back on to the 39,000. That's going to be your net profit before your interest that was paid off, which is 20,000. There's no tax in this question. So your capital employed then is 621,000. So your formula, net profit before interest and tax divided by your capital employed multiplied by 100 over 1. We said your net profit was 39,000. We're going to add on the 20,000, which is your interest, and you're going to divide that by 621,000. So it's 59,000 divided by 621,000 multiplied by 100 over 1. So it's 0.095% multiplied by 100. So it's 9.5%. So remember, with each one of these, you need to use the correct units. So part 2 is percentages. The previous one that we did, part 1, was euro. So make sure you put those signs in. So net profit before interest and tax divided by your capital employed. 39,000 is going to be your net profit from the question, from your profit and loss section. You're going to add on your interest, which is 20,000. So our net profit then is 59,000. Divide that by your capital employed, which is 621,000. So the return on capital employed, that's like the return on the investment that investors give. And you'd compare that then to your risk-free investments of 1 to 2%. So your return on capital employed should be compared to risk-free investments to venture preference shareholders. The company is profitable if the return on capital employed is higher than the return from the risk-free investments. So this is the return that the shareholders are going to get for the money that they're putting in.